For now, we're going to take a quick trip back to last month. It was December 3rd when our next guest, Michael Lee, called on investors to buy the 1.4% dip that we were seeing in the Dow Jones Industrial Average that day.
I've said it here before and I'll say it again. Every single sell-off we've had that's been related to trade-related news or tweets has been a fantastic buying opportunity over the last almost 2 years now. I see no reason why this is any different.
And there you go. So let's bring in Michael Lee, founder of Michael Lee Strategy. It's great to see you. So you said, I see no reason not to buy this dip. We were down almost 1.5% at that time. The low of the day was 27,325. Even in that day, we moved 500 points. We're back at Dow 29,000. So you really bit the bullet that day, because I know you're always bullish. And I was wondering whether on that day you were going to say buy the dip, and you did.
Yeah, I think that's going to be the mantra. We're getting towards the end of the cycle, but looking to buy on the dips and buy on weakness and add cash. I think that's what investors need to be looking to do for the remainder of this year. And at some point, we're going to go over the cliff, and markets will change. I think what's going to drive that is corporate leverage. So right now, if you look at earnings versus debt in the S&P 500, we're at all-time highs, where the cost to borrow money for those companies is at all-time lows. At some point, that's going to change. It could be years from now. I anticipate some point in the middle of next year, right? And now that we're getting towards the end of the cycle, valuations get really, really crazy. So we're at about 18 times forward earnings. In 1999, we got to 25 times forward earnings. Very different
from 1999. I'm glad you pointed that out, because valuations are nowhere near what we saw before the bust.
Yeah, you're looking at 7 times, an additional 7 turns of the PE multiple at 185. It's another 1,200 points the S&P 500 that puts you in the mid 4,000s. I don't think we're going to get there. I think the chance of us getting close to a 4,000 S&P by the time we're done is very, very reasonable. It doesn't represent that's not that big of a move from here. That's only another 20%. So I think that's definitely a possibility. Some other things to remember. People talk about this being the longest bull market ever. I don't think so. You hit 1,500 in the S&P 500 in 1999. You did not get back there until 2013. So really, we've only been running since 2013. That's also when the NASDAQ, surpassed its 2000 highs. So we're only 6-7 years into this.
I see.
And bull markets are typically 17 to 20-year phenomena with corrections in between.
So your starting point is not 2009, but in fact your starting point is 2013, which gives you more room to run, assuming that everything stays the way it is. Earnings, right, with some good fundamentals, low debt. Some of the other things that you are also watching is consumer and household and wage gains. All of that is good news.
Yeah, so Jamie Dimon this morning, JP Morgan blows the doors off earnings.
Yes, he did say that.
Jamie Dimon's talking about how good a shape the consumer's in. So the best labor market in the history of the United States. We're finally getting some spectacular wage gains, and with low inflation, real wage gains. If you look at consumer debt to assets, lowest level in 30 years. You look at debt service as a percentage of take-home income, lowest level in 30 years. And the savings rate is up near 7.5–8%. So we can go a long way in the economy with the consumer unless the labor market substantially deteriorates. So I think there's a lot of room to run in the market.
So the 7.5%, there's 2 ways to look at it. That people feel great, they're saving money, they're making money, they're putting it away, or they're scared and they save it. It's the first scenario, right?
Well, it almost doesn't matter. What it's not is euphoria. When we don't have the consumer overextending themselves the way that they were pre-crisis. So let's just say in 2021 we do have a correction and a bit of a recession. It's my view that this next recession will be relatively minor, because all it's really going to consist of is corporate deleveraging. There are no other real bubbles in the market. Maybe we get a re-rating on the S&P 500 from a 20 multiple to a 15 or a 14, and that won't be good. But it'll be nothing like 2008, because if you look at
very different.
Well, most people who had a net worth in the United States, 90% of it was in their home and the equity in their home, and for 3/4 of those people, 100% of that evaporated. So that's a catastrophic event. It's a 100-year storm. So everybody's preparing for the 100-year storm, even though we had one 10 years ago. So I'd say this next one will be relatively minor, and then we'll be on our way. And if you look at the backdrop right now, the other thing to look at is interest rates are low, and they're going to be low. And not only that, we have quantitative easing. We had the Fed pumping money into the repo markets to make sure dealers and asset managers can go out there and keep buying. So I don't see these things changing materially at any point in the next 12 months.
Let's get to your pair trade. You've added to the pair trade, right? You always had the two and you added one more because you see the growth happening and you see the need. So tell us what the pair trade is now.
So technology and utilities, keeping them in there. Utilities, great yielder, performs well in down markets, does well in up markets too. Technology is the leader of everything, right? The NASDAQ is just going wild.
You could just say the leader of everything. You could just put a period. Yeah. You don't even need to explain, all right? It's just crazy.
But then adding healthcare. So over the last 12 months, only a 0.25 correlation to the S&P 500. So when you add the three of them, you can get an S&P 500 like or greater return with a lot less correlation in it. The largest job growth is happening in the healthcare sector. So the XLV is an easy way to play this, easy way for clients to invest, and a nice little buy and hold strategy as part of any trade that baby boomers aren't going to stop getting older. Americans aren't going to stop wanting to get healthier. There is no solutions in sight to get the cost of healthcare down. So these companies are going to continue to perform.
So XLU, XLK, XLV, and pair it together. So what would be the allocation? Are you saying 33%?
Yeah, a third. You put it in there. You're in theory, you end up with an S&P-like return with like a 20% less vol.
And you get some nice dividends from at least the utilities part, because even though the utilities is up over 6 months, 7%. Technology is up nearly 20%, right, the XLK, but you're getting the dividends from the utilities, and you're sort of hedged for the downturn.
Yeah, and then the XLV, it's low correlation to the overall market, and whether or not we enter a recession or not, people are going to continue being healthy. Old people are going to continue to get older. That's just how it works.
Michael Lee, founder of Michael Lee Strategy, making some great calls on here in December, and it's nice to have you back on again today. Thank you so much.